Hello, Jack, Chandler, and Alex. I wanted to take a couple minutes here in our recent events to discuss some of the transactions that we're looking for in the marketplace. There's so many questions in the marketplace right now about what lenders are active, what asset classes are being funded, and how to structure transactions. I thought it would take a couple minutes to discuss some of the things that we're looking for here at Commonwealth. Jack is founding member of Commonwealth Capital. The purpose of our lending platform was started to provide bridge loans and hard money loans for borrowers in the Mid-Atlantic region for commercial or investment purposes up to $2.5 million. The firm was started 10 years ago. Can you discuss what the lending environment was when you started Commonwealth Capital in 2010?
It was suspiciously like the lending environment we find ourselves in today, Andrew. Wasn't much different. The Wall Street meltdown from the mortgage fiasco in 2007, 2008, 2009 was still hanging over the country. Banks were reluctant to take any new credits, and they were reluctant to lend money to credits they already had. So lots of businesses were missing financing that they needed. I thought there was an opportunity for a private lender to fill that gap, and we started the company on that basis. And we were right. Banks, as you know, are statutorily not programmed for much risk because they are using people who deposit with them to fund their loans, and those people need insurance from the federal government. There's a whole layer of regulatory platform there that requires them to be different in their analysis of credit than private lenders like us are allowed to be. Mm-hmm. So we set off to fill that gap and have been very successful in doing so and continue to do so today. I don't think that today's lending environment is going to be much different than the one when we started. I think we're going to find a lot of customers coming to us saying, my bank can't help us, won't help us, doesn't know how to help us. We need a business lender like you guys.
And you've seen more than a handful of downturns, recessions, unexpected global events. What are some of the lessons that you've learned from the past that you're applying today?
Well, certainly the one thing that we all say to ourselves every day is that this too shall pass, as we're talking about the confinement we all share. But that's also true with the business environment, Andrew. There were a lot of people back in 2009 that said that the Great Depression is upon us and we will never again see those house-bound days of yesteryear. And of course we did. The market in the last couple of years has been great. Real estate's been strong. Been a lot of money available for business growth. And I think that's going to happen again. The question is not whether, the question is when. Do I think it's going to be a sharp V-shaped curve and that we're going to pop right out of this? Probably not. I think it's going to take a while, and I think the banks will continue to be very conservative. They have to measure by numbers. We are able to measure by business instincts, which we do with a lot of our credits, and that's why we're seeing the success that we see today.
And to add to that, the regulatory framework that Jack referenced, that's not going anywhere. The banks are going to be under the same statutory requirements they were 10 years ago as they are today, and there's really no appetite to change that. So we should have a strong place in the market for the foreseeable future.
Yeah, great. Chandler, that's a great add-on there. And as president and CEO of Commonwealth, how do you think that the corona pandemic is going to impact our business here in the next 3 months to maybe the next 2 or 3 years?
Sure. So it's a double-edged sword. There's a tremendous opportunity to originate and close deals that we otherwise would not have been able to see. Higher credit quality would have gone to lower cost national private lenders. Deals that banks couldn't turn around quickly enough because of some timing liquidity crunch due to the coronavirus crisis. And we've actually been able to buy some discounted loan portfolios from lenders that are seeking liquidity. That's been a tremendous opportunity for us. So we're replacing some of the lost business that obviously everybody is seeing right now. But inevitably, there are going to be defaults in our portfolio. Not every business is going to survive. That's an unfortunate reality of the current climate. There will be foreclosures. There will be judgments. There will be litigation. It will be long and painful for a portion of our portfolio. But once every 10 years that happens, we're well prepared, well capitalized, and ready for the onslaught when it occurs. You know, there's no way around that. But so far, all in all, we're steady as she goes.
And you mentioned we were able to get a couple portfolios closed and loans closed since the pandemic has started. How have we been able to do that so far?
Connections. We know people in the industry. We're well respected. They know we have capital, which is important. You always got to show up with the money at the end of the day. And we're honorable guys. We act on good faith, and we try to do a good job for everybody involved and give everybody a good deal. If it's a bad deal, really for anyone, I want everybody to walk away from the table feeling like they got what they came there for. So we provided liquidity for the company we bought the loans from, and they gave us some really great assets at a reasonable discount.
And able to work through title companies and closing issues, appraisal issues, you know, as they come up on each loan.
Sure. So for the portfolio acquisition, those were obviously done prior to the point where we stepped in.
Do you have any feeling on how the pandemic is going to be affecting real estate values so far?
Yeah, Andrew, you know, it's tough to say to what extent the COVID-19 pandemic will impact real estate values. In my opinion, it's pretty early on here, and real estate's a lagging indicator. So I don't think we'll really see the full impact until, you know, somewhere down the road. You know, there simply aren't sales comps to support the lower values at this point in time, in my opinion. That being said, I think we can all expect real estate values to drop in some asset types more than others. I think for the foreseeable future, restaurant properties won't generate as much income. I think that's a clear reality. And even, you know, if they get their businesses back up and running, you know, less and less people are going to be going out to restaurants and feel comfortable doing so, especially older folks. I think less people will probably be living in cities as a result. There are going to be a wave of interesting things that come out of this. But again, I think real estate values will be negatively impacted. Single family homes, not as much. People still need a home. I think those values will be pretty stable. So in underwriting these new deals, you know, we are discounting certain property types to some extent in our underwriting analysis, and some property types more than others. But again, we're pretty conservative from an LTV's point of view. And that's, you know, how we're approaching things.
Yeah, understood. And of course, the main crux behind all commercial and investment real estate is cash flow. So how are you reviewing cash flow now, given current events?
Yeah, I mean, in addition to reviewing rent rolls and lease agreements for properties, and I assume you're referring to cash flow on income producing properties, we may very well request bank statements to confirm that rental payments are in fact being made. We also might ask for interim financials for the tenant, which the landlord has every right to request. And if we really like the deal, the property, the borrower, and there's enough equity in the real estate, we might very well set aside an interest reserve for 6 months to a year to accommodate the borrower, get them through this tough period, and have us be in good standing as well from a loan point of view. And I think for that reason, you know, we're not just looking at lease agreements, rental payments. We want to see other types of cash flow, whether it's a salary or operating business income. Multiple sources of income is a big bonus for us here at Commonwealth.
Sure, and Alex and Chandler, I'll ask you both. Alex, I'll start with you. What are some of the transactions we've seen in the last couple of weeks that we've liked, and what are some of the transactions that we've stayed away from that we didn't have enough comfort?
Yeah, so as Chandler alluded to before, we recently acquired a loan portfolio. We essentially handpicked 5 notes to purchase at a discount, which gave us a pretty good return, and we were comfortable with the collateral, the borrowers, the cash flow. Those loans totaled roughly $1.5 million. The real estate was in New York City, Baltimore, Northern New Jersey, and the greater Philadelphia area. And a few of those loans also had a construction component, so we're still doing those types of deals as well. We also put out a term sheet recently for a borrower with a transportation business that plans to acquire an operating property at a discount due to an environmental remediation problem. The sellers are trying to get rid of the property, and he has a good deal over and above just the discount for the environmental remediation. So, we reviewed the borrower's financials, which are strong despite the pandemic. He hasn't been impacted as severely as other types of businesses. He's putting substantial cash in the deal, which we like, shows skin in the game. And we're waiting on the appraisal report, but we expect a fairly high value that'll give us the LTV we're looking for. The last thing I'll talk about is a deal that we didn't do. As I alluded to before, restaurant transactions are inherently more risky from a credit perspective. We had issued a term sheet to a restaurant in southern New Jersey prior to the pandemic. That term sheet expired before the borrower signed it. The borrower came back to us after the pandemic, and at that point in time, we weren't prepared to move forward. We had cash flow concerns and wanted to put things on hold before committing to funding that transaction. So, again, restaurants we see as inherently risky. On those types of deals, we're probably looking for some outside collateral or cash flow or both. But hopefully that gives you a little information on what we've done, what we've seen, and what we're looking for.
Sure, that makes sense. I think that's really helpful, just to try and give some of our borrowers and some of our referral agents some clarity and some information about what kind of transactions we're looking for. Of course, we're lending in the Mid-Atlantic region, Virginia up through Connecticut, 100,000 up to 2.5 million. We do see a lot of transactions, unfortunately, that we can't do. So I know 2 resources that I've been using a lot and referring out has both been Scotsman's Guide and American Association of Private Lenders, to be able to find the local lenders in the market who might be doing some of the more difficult deals or deals that borrowers and referral agents have had loan commitments pulled on. So 2 resources I wanted to put out there for some of our network to be able to utilize as well. We're certainly looking forward to evaluating more loans here, and we're active, of course, phone, email, and website. So feel free to reach out to us here at Commonwealth, and we look forward to trying to help you with any transactions you might have or being able to point you in another direction. So thanks from all of us here at Commonwealth, Jack, Alex, Chandler, and myself. We look forward to speaking with you soon.
Thanks, Andrew.